Welcome to the ROI Masterclass, the podcast where vision meets strategy and bold moves create measurable results. I'm Liat Siegel, interior designer and ROI strategist with 17 years of experience. I help businesses transform properties and ideas into high-performing assets. This show is specifically for real estate investors, hospitality operators, and boutique developers who aren't afraid to take risks, challenge the status quo, and demand a return on every decision they make. Each and every week, we talk with innovators and leaders across industries about the strategies and the insights and really all the unconventional thinking that turns potential into profit every single time. If you believe that smart design, decisive leadership, and strategic risk are the keys to real ROI, you're in the exact right place. Let's dive in. Welcome back to the ROI Masterclass, the podcast where vision, strategy, and bold decisions drive real results in real estate and business. I'm your host, Liat Siegel. Today, I'm joined by David Priest, a seasoned capital raiser and fund manager with a unique perspective on the multifamily and commercial real estate markets. Over a 20-year career, David has personally originated more than $600 million in mortgages, transitioned from single-family transactions to commercial real estate, and carved out a niche as the go-to expert for raising capital across diverse asset classes. David's expertise lies in understanding market dynamics, evaluating business plans, and ensuring that investments make financial sense for both operators and passive investors. He's known for his candid insights on how market fit, timing, and strategic improvements, not just design, drive true ROI in today's shifting real estate landscape. Today, we'll explore how capital strategy, market analysis, and disciplined investment decisions can make or break a project, and why sometimes the smartest move is knowing when not to improve. Let's get started. Thank you so much for joining us, David. Tell us a little bit more about your background and how you got into what you do and what kept you there.
Thank you so much. So yeah, my journey is really long. I started out about 20 years ago, as you mentioned, in what I call transactional real estate. So transactional real estate I was a mortgage broker. I did about $600 million in mortgages by myself. I wasn't a part of a team. I was a loan operator. And it sounds like a lot, but it was over about 20 years. So it's about $30 million a year. It's not that amazing. It adds up. But I got a lot of experience in dealing with people and dealing with money and digging into people's lives. Mortgage is very intrusive. It's the most intrusive financial thing that you'll ever be involved in. So I felt pretty comfortable with that. I got into commercial real estate about 3 years ago. And my first real problem that made me think about it or want to get involved with it was I had been a stock market guy. I got married in 2008. The market crashed. I already had money saved up. My wife had money saved up. And I said, well, this is a once in a lifetime opportunity. We need to throw everything we can in this and do the stock market. And we did that for about 12 years up to 2020 and made a lot of money. I was throwing money in when it was, 6,000 on the Dow or whatever. And we did really well. So we created our initial tranche of wealth that way. Now I got shaken out and pretty much I lost my confidence in that market during COVID, because when COVID hit, it came out of the blue. It's a black swan, get cut in half, and it's all on the screens. And there for 3 months, it was cut in half for a while. And every day I was waking up going, I can't believe I just lost half my wealth. How does this happen? In the meantime, real estate was pretty much unaffected during COVID. In fact, residential property started going up in value. So I saw there was a problem and I said, I got to get into real estate, but I didn't really want to go buy single families. I was afraid of managing them. I had not bought any rentals for myself this whole time. So imagine doing $600 million in mortgages and hundreds of real estate transactions as a broker and never buying an investment property. I was scared of the management. I was just terrified. So it was a mistake. If I had been buying properties back in 2010, I would have done really well, but I was afraid of it. So if you're afraid of buying rentals, I've been there. So I was going to be more of a passive investor. And I started getting involved with people that were doing syndications and trying to learn that business. And I was trying to get educated. And I made the mistake of going to a real estate conference and started to hang out with the people that do it for a living. And I was like, these people are really cool. This is like my tribe. I think I found people that I actually relate to. Everybody in this room is kind of a unicorn, and I'm a unicorn. So this feels right. So I decided pretty quickly that we were doing some passive investments, but I want to do this as a profession. Like I want to do this professionally and kind of transition from other businesses. So I started making that transition. And the final touch for me though was in 2022, I got diagnosed with leukemia. And that was right in the middle of all this. Everything was going. And I was like, well, I really want to do this. Do I, am I ready for this? Am I too old? So when that happened, I had to take about 4 months off, and I had to do chemotherapy. I had to do, some medical treatments. I quit working, and I decided, I took some time off. I had time to really dig into the real estate even harder. And then when I wasn't working, obviously I wasn't making money. So I had the big 401k IRAs or whatever, and I wasn't working. And I was drawing off the top, which most people would call retirement. I call it panic city. It's when you quit working and you start drawing off the 401k and IRA, even if you have millions of dollars, it is no fun. So I didn't like being retired. I was retired for 4 months, and I don't plan on doing that again. But it gave me that push to now I want to go and do real estate full time. I want to go do deals. I want to be a syndicator. And originally I was going to go in as an operator and go and buy my own deals and build my way up. And that really wasn't a good plan for me. I was able to learn all the skills, but once I got into it, I kind of found out how hard the operations part of it was. And I had operators telling me, you can do this. I'll help you. We'll mentor you, but it's going to take you 10 years to be good at it. And I decided I was at an age where I don't want to spend the next 10 years in the hard knocks. And I had helped someone with a project raise money. And I knew I was good at that. And I was real comfortable talking to people about money. I've been doing it for 20 years in the mortgage business. So I gravitated toward the capital raising. And at the time too, and still right now, it's hard to raise money. So it's a skill that is well compensated and it's well appreciated. So that's what I do now. I've done about 5 deals, about 800 units of apartments as a general partner. And now we do a fund. We're doing other classes of real estate. And we also have a program to protect people's principal. And this is something that nobody else has. We came up with this a few months ago, and it's a way to buy protection, downside protection on the deal. So we're starting to do that too. And that's something we're introducing.
Tell us a little bit more about that. That sounds intriguing.
Okay. So the principal protection program, this was I'm going to give my wife credit on this. She came up with the motivation. She was the muse on this. What happened was we were having a conversation. She had a friend that was talking about they wanted to invest with us, but they were in another deal and it was in trouble. And she said, I don't want to really invest any more money right now because this deal we're in right now is not going well, and I'm scared and I don't want to lose money. And I'm just really worried about it. My wife came to me and said, look, she's worried about losing money. And I'm worried too. What if we raise money on a project and then it goes bad and we have people in our orbit or our friends that we lose their money? That's going to affect our friendships, our relationships, going to be really horrible. And of course, I said, well, I'm doing a lot of due diligence here, and I think I got a really good program and plan, but how can I guarantee we'll never lose money? It's not possible. And so my wife looked at me, and when she does this, it's really good. She looked at me and she said, you're a smart guy. Figure it out. Figure out a way to make it work. There's got to be some way to make this work. So that was really a smart way of doing it, because the connotation was if I couldn't come up with some way to fix this problem, I wasn't a smart guy. So that got my wheels working really hard. I had to come up with something. So I started studying Wall Street and how they have downside protection on financial products, and then also life insurance. How they, like index life, you have a return that is a portion of the S&P 500. But if there's a stock market crash, they give you 4% no matter what. How do they guarantee? How do they do that? So I started looking at that, and I came up with an idea that we would keep a capital reserve. So people would buy protection. We put it in a capital reserve. We hold the money during the term of the investment. We pull every investment and every investor into this. And then if a deal goes bad, we should have enough money to pay the people back their principal. And it's an optional program. So we're not making people do this. We're not forcing them. It's almost like when you book a cruise, and if you want trip insurance or not, you accept it or you decline it or whatever. It works like that. So you have the ability to decline it and the ability to accept it, but nobody else is doing anything like this. And it's not an insurance product, and it's not related to insurance companies. Because when I started looking at this, I was talking to people, and they said, well, you can go to Lloyd's in London and have them, reinsure this and create a product for you. They'll do anything. And I just decided that was a bad idea because I was terrified that if something went wrong and we really needed the money, the insurance company wouldn't pay. I tend to not believe insurance companies based on, do you watch the movie The Big Short?
No, tell us.
Oh, watch that movie because Wall Street, there was all kinds of insurance bought in the financial crisis against mortgages. And when everything went wrong and Wall Street thought they had the money made when they had to actually pay out, they tried to weasel out of it. So I don't trust, and anyone who's ever dealt with an insurance company, a major claim knows what I'm talking about. So we decided to put the money in a cash reserve. We're very transparent about it. If you buy in the program, we put the bank statements online every month. It's the bank statements. Here's what came in. And if we're not paying out, the reserve is growing and growing, and it's there to bail people out. Now, once the deal goes full cycle, people have gotten their money back, then it becomes profit for us. But this is a 3, 4, 5 year, thing that it's not going to make any money overnight. But we want to have people have confidence because I think right now in commercial real estate, it's the second best opportunity of a lifetime. The only thing it was better, if you go back to the time machine and go back to the financial crisis, that's a better opportunity. But especially in multifamily, this is the second best chance that in the last 50 years.
Tell us a little bit more about what you mean in terms of now being the time.
I'm just basing it on prices. So like, for example, multifamily in most markets, it's 30% cheaper than it was back in 2022 in most markets. And so going back, when I was talking before about the financial crisis and getting married and being a stock market investor, when everybody says something crashed, it's crashed, it's horrible, it's the worst news of all time, that's when I get really interested in starting to buy things. So it's like, if I hear crash, oh, what crashed? Okay, I want to go in and start buying this stuff. So we started buying things in late 2023 and 24 is when I really jumped in and started buying things because it was down enough that on deals I'm in now, even if they just go back to the 2022 prices over 5 years, we're going to make a lot of money. So it's kind of a no-brainer. But when you have a investment product or an investment or whatever, and the returns have been stellar for years and people are saying, hey, this is killing it, it's doing 20% a year, be careful. Because that's when, that old saying that past performance doesn't indicate future results. That's what they're talking about. But if you can buy things that are out of favor or crash, or like if you're buying single family, if you're buying a foreclosure or you're buying something below market, that's where you want to put your money. That's where the value add is getting a really good price.
I've been talking to so many different investors who have said that things in the market are very tough, especially in the commercial market. Do you think that it's bottomed already, or do you think it's going to get worse, or is it only getting better from here? I mean, obviously it's hard to tell and you don't have a crystal ball, but
I've got my crystal ball right here. Let me grab it. Okay. So here's what I think. I think we're in a zone where I have someone I know that I follow named Neil Bawa. He's an expert on multifamily. And he says, buy the smile. So is it at the very bottom? No, but it's so close that you're in that smile range of the bottom. I think there's a good chance it has bottomed out, okay? Because it's down so much. And also, too, there was a rapid decline over about 2 years. And it seems like the last 6 to 9 months, maybe even almost 12 months, it hasn't really changed. It was going down and then it's kind of flattened out and it hasn't changed. There are also several things that are going to be a boost coming out. One is bonus depreciation going back to 100%. The new tax bill that was just passed, that is heavily laden with real estate. There is also talk yesterday that they're going to allow 401ks to invest in private real estate investments. I read that. That is a rule that's going to be implemented. Now, I think that's going to take a while to get implemented. I'm not sure exactly how they're going to do that. I was talking to someone this morning about it. And it's one of those things where the president throws out this amazing idea, but there's really no plan to implement what the idea is. So the mechanics of it may take time. But I think the bonus depreciation, also, I think interest rates are going to come down. So the Federal Reserve has been very hesitant to lower the rates. And I think Federal Reserve Chairman is probably going to be replaced. And so they're going to bring rates down. And when you have rates coming down, you should have cap rates coming down a little bit, or at least put a stop on it. But I like the action where it hasn't kept going down. It just feels like it's bottomed. And once you have some upticks, a lot of buyers will jump back in. And also, when you have lower interest rates, a lot of deals start penciling. They weren't penciling before. So I think that's where we're heading. And also too, if you buy something now, and let's say it goes down another 5 or 10%, but you've got a 5-year timeline and it goes back to where it was over 5 years, you're going to do really, really well. So I think there's more risk in not getting into things now than like waiting for the super crash that hasn't really happened. I think people on the sidelines, you don't have an opportunity to do anything at all or to make money. I mean, if you're just waiting, I mean, what are you waiting for? When will you know when's the right time? But when I see things down 30%, I get pretty excited.
I mean, that's what I've been hearing again and again. So it's very great to hear you also confirm that. We've had people on our show say the same thing, that now is the time to buy. Now is the time to invest. I know that you're scared, things can always, but real estate is a risk. And as long as it, pencils to some degree and it's a calculated risk, then you'll see the returns.
Yeah. I mean, everyone wants to quote like Warren Buffett and like buy when there's blood in the streets. But then when there's blood in the streets, there's very few people that have the courage to actually do it. They want to talk about it. Their thing is, well, there could be more blood in the streets in 6 months, so I'm not going to do anything right now. So I think you have to have the courage to get out there and at some point make a move. I think you also have to look at previous mistakes that people made the last few years and don't go make the same mistakes. So the deals I'm doing right now, we're only doing fixed rate debt. I'm not doing any bridge debt. I just don't know what future interest rates are going to be. And so I don't think if you want to do this kind of deals with your own money, go ahead. But if you're raising investor money, it is not worth the risk entailed that we could lose people's money. So I don't do those. And I want deals that cash flow right away. So immediately. So you can close, have cash flow. Obviously, you're going to improve the cash flow. We want to get it up a lot. There's got to be a good value add component. But if it doesn't cash flow right away and people are like, well, we're going to go in and do a really, we're going to have to bring in new tenants with a lot of construction. Those deals are very risky right now, especially with tariffs and things like that. It's very difficult to predict construction costs. So I think you've got to be really, really careful. And it's better to raise a lot of reserves, get into the deal, and then see what happens and have the money there to do the construction, the rehabs we need to do, but realize that it may not be necessary. You got to be very careful. I think there was a lot of people that were over improving properties that were not in great locations or bad areas, thinking they're going to raise rents. And right now in this economy, since 2022, most people that are renting are really stretched thin on their economics, their ability to pay rent. And you can't go in and start raising rents $300 a month in everybody in an apartment complex because everyone just moves. That's very hard right now. Yeah.
I mean, in New York, I know of a situation where they tried to raise it by $1,000. So that is what's happening. And we spoke about before the different types of properties and value adds. Can you tell us the difference between, a single family versus commercial property or a multifamily in terms of value add and design improvements?
Yeah. I mean, I think one of the mistakes that a lot of people made was a lot of people that got a multifamily, let's say 6, 7, 8 years ago, maybe 5 years ago. They came from a single family world where you could go in with a single family property and do a flip or a rehab, and it would almost automatically raise the value of the property because you had done improvements, and it might, you might have a property that went up in value of $50,000. With commercial, it's only if it's increasing the net operating income. So you can go and you can make the inside of the property amazing, but if you don't have the ability to raise rents, it doesn't increase the value of the property. On the other side, you can go into a property if the rents are below market and do nothing and raise rents. And if you're able to do that organically, that's a better way to do it if you can find those deals. Usually it's a combination. So if you can find a deal where the rent's already below market, and then maybe we're in a location where we can do some rehabs, and you kind of experiment with it. Like, okay, let's go in and let's raise rents very little organically. Let's try to keep our occupancy up. And then when someone moves out and we can't help, maybe they're getting a new job, moving to a different state, we can't keep them in there. Then we go in and we rehab. Maybe we do some improvements. And then we see is the market will take a rent bump of $150 or whatever. Can we do that? And if it won't take the rent bump and you don't know the market, then you need to be very careful going in and improving stuff. Just because you go in and do a construction project doesn't mean you're going to bring in more money. And what a lot of people did was they were burning through their reserves And if you're on bridge debt, when the rates go up, they couldn't handle, they didn't have any reserves. They put it all in the building. Now, the beautiful thing about buying foreclosures right now, like I bought one last year where they had spent $3 million in CapEx on the property. New roofs, new paint, rehab 30% of the units, like 100 units in a 300 unit apartment complex. So we're able to go in and buy it at a 30% discount, and all that CapEx they spent, we got it for free. So those are like really wonderful deals when you can find someone else did all this work and you can take it. It's unfortunate for the investors or the people that are in that situation. But if you're in that type of a situation, a bank foreclosure, nobody wins. It's not good for anybody. Basically, it's bad for the operator. The investors are going to lose money. The bank is going to own the property and they don't know how to run properties. It's bad for the tenants. When you're going into a foreclosure, a lot of times the people that are on the maintenance staff or the property management company, they throw their hands up. They know they're going to be looking for a job in a few months and they're already planning their exit. So foreclosures are bad for everybody. So if you can swoop in and avoid a foreclosure, it's a better situation for everybody. And the banks really don't want to own these properties.
Right. So what I'm hearing is that you're saying to be strategic about the renovations and the adjustments that you're making on the property to have the maximum return.
Yeah, I mean, it's be careful because so let's go back to 2020, 21. People were buying properties and they were literally saying, we're going to raise the rent so much that we want people to move out. Like we want people to leave because we can rehab these units. And then when they're rehabbed, we can get the rents up enough that it's going to make the property a lot more profitable. They're actually trying to create vacancy to do rehabs. So what I'm saying right now is I think that's a horrible, horrible strategy. Unless you can find a really rough property that's in an amazing high income market and high end location. So that would be like kind of a unicorn where it's, you've got a property that's run down and it's in a suburb and it's low crime and the family incomes are $200,000 in the area or something like that. If you can find that kind of property, that would be a really great plan that would work. But you have to find somebody that's a delinquent owner or somebody inherited the property and doesn't know how to run it, or they just didn't put any money in, it ran down. Those properties are very, very hard to find. So I think you've got to be really careful about, are the rehabs going to take the rent bump? Or are we just spending money and we're not going to get anything out of it? And while we're doing the rehabs, obviously the units are vacant. And the worst thing in any kind of real estate, no matter what it is a unit that pays $0 that month. I mean, we don't want these below market rents. Well, if it's a below market rent and they're paying $807,000, that's better than zero. You want to move them out and have a zero? I mean, it's still better. I mean, I don't understand. I mean, I know people that they're trying to raise rents 10%. And then they lose 10% of the occupancy. Well, if you do that, you just broke even. So you've got to be really intentional about it. I think you've got to wait, and you wait till people move out. You're not trying to make people move out. And maybe you rehab one or two units and you give a premium. Hey, we've got a classic unit here. We've got a unit that's upgraded and, marble granite countertops and, nicer finishings, nicer appliances. And you see if you can get somebody to pay $200 more for that. And if you can, fantastic. But you can't assume that you're going to go rehab half your units and everybody's going to pay more, because I think the economy, the way it is right now, people are just really stretched, paying gas and groceries and everything else. They may want to live in a less expensive, less renovated property. So it's really difficult. And people that love construction, they just want to go build and do these kind of things. And they really love the process of making it amazing and making it pretty. That is cool. But if it doesn't handle the rent bump that you need to make it worthwhile, it's not you have to be really careful about that.
I would love to know from you, we were talking a lot about the importance of understanding the hyper-local market. Can you tell us a little bit about that and how that impacts the ROI of a property?
Well, I think the operator has to have experience in the market. So if you can find operators that they're in the market, already own properties that are close, so they understand the market. And then also when they take over the property, the best operators right now are very cautious about jumping in and, immediately going in and doing a lot of construction. I mean, generally they're trying to take over the property, make sure it's stable, get the occupancy up if they need to, just focus on getting the occupancy up. And then once the occupancy up and the property feels very stable, then you can go in and do those renovations. And there may be stuff early, obviously repairs or a roof. You don't want a leaky roof or something. or doing a sign or some minor CapEx. But on renovations, I think you got to get in there and figure the market out. You do a little bit at a time and you see if the market can handle it. And if you're getting feedback that it's not working or that you're not getting the rent bumps you have to back off of that plan a little bit. But the key thing is keeping the occupancy up. And it's been difficult, like here in Texas. I'll give you an example. We are having trouble with occupancy in some markets because it could be a demographic that's more Hispanic. And right now we're having ICE raids that are coming on properties. They're picking up one bad person, but we have this police presence or this, it looks like the SWAT team coming on, and they pick one person up. And then what happens is the rest of that community, there's a lot of fear. And then all of a sudden our occupancy drops 5 or 10%. And it skips, they leave. So that's something we're dealing with right now. I think it's a temporary problem, but it's another reason to be cautious. You don't want to do anything that's going to get people to move out, because when properties get in trouble is when occupancy drops, generally. So you've got a debt problem, variable rate debt, rates go up. When occupancy drops, you get under your break-even point. That's when you start running out of money. So the whole thing with management is keeping the occupancy up right now. And that's the thing we're dealing with locally, that I think is a temporary problem, but it's another reason to be cautious, because you have external things that you have no control over that are outside of the property that affect your ability to manage and to keep your tenants happy.
So in this market specifically, and also understanding the hyperlocal market, it's important to focus on the occupancy, keep that up. And then once the market shifts, changes, or people move out, that is the time to do those strategic renovations.
Yeah. I think the main thing is not trying to force vacancy. There was a period there where people were value adding properties and they were saying, hey, the rents are $300 below market with renovations. So we're going to try to raise rents, people to market, and try to get them to move out so we can renovate their units. I think right now that would be a really, really, really bad idea. I think it's better to wait organically until you have a tenant you can't hold on to, and then let them move out, renovate some of the units, give people a choice and see what the market can handle, and just be careful about it. But just because you renovate units doesn't mean you're going to collect higher rents. And I think that's a problem a lot of people are dealing with. And it really depends on your market too. Now, let's say you're in a more of a high-end market. You might have to renovate the units to attract the type of person. You might have a higher end demographic where a person comes in and they're a younger person with a fantastic job and they're driving a BMW and they walk in your unit and look around and they go, man, this place is a dump. I want something nice. Where are the nice units? So you've got to know that market. And so you've got to make sure you know what people are looking for and understand it. And you can give people different choices. Some people just want a classic unit. They're trying to keep their rent as low as they can. And there's other people that want it spiced up and they'll pay for it. And getting that mix is really difficult.
So having design in those specific markets at obviously the right time, would you say that is the strategic smart move to make?
Definitely. And I think a lot of it is understanding how aesthetically you can make the property more appealing and at the same time spending the least amount of money to get the aesthetics right where you need them to make it attractive without spending a lot of money. It's difficult. Sometimes you have supply issues, you've got tariffs, you can have labor force issues, contractors, construction costs. So it's really difficult. And a lot of it's knowing that hey, we can get this done at a low cost and this is going to add value. It's going to make the property look better. It's going to make the tenants happier. And they have a feeling like this is home and it's more permanent. So that's the other thing too. If you have the good design on the inside and people really love where they live and they love the design of the property, they're less likely to move out. So you might get renewals. You might get an easier rent bump. It all works in. The design of the property, the management, how they're being dealt with respectfully. Are the rent bumps you're going for organically, are they, respectable and what did the market? If you're raising someone's rent $30 a month, they probably will take that, and they don't want to move over $30 a month. So it's finding that secret where it is. And also too, one thing that a lot of people don't look at is maintenance. And when something breaks in a property, it will, is getting it fixed quickly and getting the maintenance people out there as quickly as you can and getting it fixed. And being responsive and seeming like you care. That's a huge thing, because if things aren't being fixed quickly, then people are not happy. It festers. It's stressful for them. Then you've got them going on your Google reviews or whatever and saying, the place is run horribly and, it's terrible. And so that's a downward spiral. And then if you have another person as a maintenance issue, the same thing not being fixed, then they got to write a Google review and they see a whole bunch of nasty ones. And then they're going to write more of those. And then people looking at apartment complex, they see negative Google reviews. So the whole thing kind of spirals. So you've got to be really careful about taking care of people and, showing empathy. When people call the front office, and they've got something broken, they're just trying to get stuff fixed. You got to show empathy for them and you got to try to fix it as quickly as possible.
Absolutely. Having a PIP plan and showing people that the property is not run down and that you care about them. That's what it ultimately communicates to them, whether, you're acting fast on any complaints or any maintenance issues, that the property is constantly being updated. Those are big things. But again, to your point, that it needs to be strategic in the right time and cost effective, increasing revenue, but reducing costs. So what kind of strategic design choices or upgrades can a property owner make that would be like the highest leverage for them?
In apartments, it seems like what's working for my people that are doing these, they love granite countertops. It's like the easiest thing to do. Now, some people do it's like the leveling on there, right? It's like a coating or whatever, and you can do those. It looks pretty good. The main problem with that is anytime, let's say someone's cooking and they take a hot pan off and they lay it on it, it melts right into it. It's just a big brown circle and it melts. The thing about granite is it is more expensive, or there's kind of quartz tops also, but it kind of lasts forever. I mean, once you put it in there, it's going to be in there for 10 years. And if someone does the thing where they lay the hot, it might make a mark, but you can polish it out. So there's one thing on we can do these resurfacings and it's $300. Okay, that's great. But then you have to do the $300 every time. Every time someone moves out, you're never going to look at it and go, so it's perfect. Great. You've got to redo it every time. And sometimes the granite, if you're going to be a long-term property owner, it's a lot cheaper because people will pay $100, $150 a month. You can get your money back in 12 months, in that range. And then it's free from that standpoint and you can charge the higher rents. So if you're in the right market, people seem like they really love it. There's also, in complex amenities, things like dog parks. I know some people are putting pickleball courts because they don't have room for a tennis court, but the pickleball court now is small enough you can fit it in a blank area. So things like that. So you can do that value add. Also, a lot of people are doing, and this is not really I think as far as design, they're doing concierge trash pickup for the property and doing that. So a lot of it's just providing more service and trying to figure out what happens. But I think the granite countertops can really work really well if you have the right market. And over time, it's actually cheaper. If you're going to own the property 10 years, you'll spend less money on granite than you would going in. And it's a lot more on the front end, but later on, it's pretty much indestructible. So you don't really worry about the wear and tear.
I mean, it takes having a strategic investor to understand the longevity, rather than just focusing on the price up front and saying, I just want the cheapest option, but looking at the strategic nature of what that investment is going to mean long-term, and also if they're going to be able to increase their rents.
Right. I mean, we have an economy, though, right now, like I said, that's stressed. There are a lot of apartment units delivered, like in 21, 22, and 24, and that's kind of drying up. So there's a little bit of oversupply in some markets. I think over the next 3 years, it'll get really soaked up. And we get down to like 27 or 28, you're probably going to have some shortages. Again, it'll be a little bit easier to raise rents. So it's knowing what your market is. There's not like one solution, one size fits all. And because you execute a plan at one apartment complex, doesn't mean you buy a new apartment, it's going to work out the same way. It could be a different neighborhood, a different demographic. Another thing that I've heard of people doing, and I think this is fantastic, when they do rent bumps, is asking people on the granite, hey, we're going to raise your rents $100 a month, $150 a month. People are like, oh, no, I can't do that. I'm not going to re-sign. Okay, we'll give you granite countertops for free. We'll come in and do them. And it takes a day or two, and they can actually do those while the people are in the unit. Or they can do it while they're gone. Let us know when you're going on a business trip, you're going to be gone on the weekend. We need 2 days, and we can do this in the unit while you still live there. And I've seen them do that. And so it's a way of getting the rent bump without them moving out and getting granite in there. And then you're not having to turn the unit either. So you save a couple $1,000s on that. And you can almost give the granite for the same price as what turning the unit would be, but you're keeping rent there and you're getting that rent bump that you wanted. And I think that's a really good way of doing it, it's giving something of value when you're raising the rent and trying not to move them out.
Wow, that's so smart. I mean, the kitchen and the bathrooms are the number one. When I advise my clients, it's the number one place to make that investment, because that's where the perceived value is.
Yep, definitely.
Yeah, amazing. This has been so much fun. We've learned so much from you. I would love to know two things. One, what would be your top 3 tips of how you would have gone about real estate differently if you were starting all over again? And then the second one is your favorite book right now.
So if I was doing it over again, I would have liked to have gotten into owning real estate besides my primary residence much, much earlier. If I had been buying things in 2009 and 10, if I'd been in real estate rather than the stock market, I would have done a lot better. Also, when I got into commercial, I had an experience where I was going to try to be an operator, and I was going to buy like a 90-unit apartment complex myself the first time. I had a plan, I had a person going to sign the loan. It was going to be a really small syndication, and I really wasn't ready for that leap. And the deal ended up going bad. We had to walk. We lost some earnest money that went hard because we couldn't get our full deposit refunded. The only thing I've ever lost money on, the investors didn't lose anything. We sent their money back. But it was very ambitious to go out and try to do that. But if you're trying to get in the commercial world, I would try to figure out where you add value and just get on a big team and try to be the caboose of the team, like the least experienced, least wealthy, just like you're just glad to be hanging out with these amazing people. Try to be that person rather than a do-it-yourselfer. And a lot of that comes into like my favorite book right now, which is right behind me. It's Who, Not How. I love this book. And I'm rehabilitating myself as a do-it-yourself person that wants to be like smart and learn everything and do everything. And what I found is by doing strategic partnerships and collaborating with people who can do what you can't do, or you could learn it, but it might take 10 years. Like they're 10 years ahead of you, and just collaborating with them and being humble and realizing that you can't do everything. That when I got to that level, and I had to make some mistakes and to realize, hey, I'm not good at this. I don't want to be an operator. I don't want to do this. I don't want to do these things. Going through those mistakes, I learned basically to collaborate with people. And that's where I've had all my breakthroughs. And I came from that do-it-yourself, single-family mortgage guy, solopreneur world. And I think you can do a lot of it yourself in single-family. I mean, there's a whole lot of single-family. It's a do-it-yourself kind of business. People love it. But if you're doing single-family and you can find people to collaborate with in single-family, and y'all can form like a group and go do what you do best, it's a lot more powerful. You can scale up a lot faster and be a lot better at it. So I'd recommend that. Do it yourself in commercial or like in apartment buildings. If you're going to go buy 50, 100, 200, 300 units, it's impossible. You really can't do it. Believe me, I tried. It's not possible. You've got to teamwork with people. Also, too, once you figure out how to collaborate, your life gets stress-free and so much easier. Doing it all yourself is so difficult and it sucks. Yeah. So that would be the one advice I give people is don't try to do it yourself. Find people to collaborate with. And I struggled with that in the beginning. I had to learn the hard way, and also read that book. It's amazing about how to partner with people.
It's by Simon Sinek?
No, this one is by Dan Sullivan and Dr. Benjamin Hardy.
Oh,
Dan Sullivan, Who, Not How. And it's all about figuring out what problem you have. And instead of going and trying to learn how to do it or solve the problem, figure out who you can bring in as a partner that can solve the problem immediately. And maybe you solve a problem for them. And it's all about collaborating. And that book for me was a big change, because once I started doing that, my life got easy. I got huge opportunities. I got to be on amazing teams. I got to delegate things off that I don't like to do. I got used for what I'm good at. And then when I'm not good, I don't have to do. But if you're doing it yourself, you got to do everything. The things you suck at are not going to, you're not going to do them very well. So you're doing a poor job on things you're not good at, or you've got to learn skills that are not natural for you, and everybody's different. And you're going to spend a lot of time learning something that you're not going to be good at. And if you can find a person that's really good at that and they're naturally good, or they've been doing it 10 or 15 years, it's so much easier just to collaborate with them. But a lot of us, and I put myself in this category, we have a lot of pride. We have a lot of ego. We want to be smart. We want to you want to stretch and learn new things. There's nothing wrong with that. But sometimes you got to admit that, I can't do it all. I'm not the smartest person. And what I found about real estate is if you go in it with some humility in the background, you do really well. But if you get out where you think you know it all and you've done it all and you're really smart, you will make mistakes, and real estate will bring the humility back into your life through the mistakes. So stay humble, be amazing, set high goals, do amazing things, but in the back of your mind, I'm humble. I'm still learning, and I can't do everything. It's like the end of the movie. There's one of my favorite movies is Patton, and it's about General Patton in World War II. Story is at the end of the war, and he's talking about they won the war, World War II. And he talks about going back in time to the Roman times. And he said when the Romans won a battle, they would come back into and have what they called a triumph. It was like a parade where they would bring the armaments and the treasures from the land, and they would bring people that it was like a conquered people, kind of a horrible thing, but they would have this big celebration. And they said that the general that won would have his children in the chariot, and they would drive along, and he had a gold crown on his head. But he said next to him would be one of his people, and they would whisper in his ear that all glory is fleeting. It's humility. So stay humble. Get help, realize you can't do everything. And a lot of our problems are caused by our own ego. So that's the big thing is if you can learn the humility part of it, man, you make a lot less mistakes.
Amazing. Thank you so much, David. It's been a pleasure. If anyone in our audience wants to reach out to you, how can they do that?
Best way to reach me is actually on LinkedIn. So it's very simple. David R. Priest, Priest on LinkedIn. You can get my contact information, and you can also book an appointment directly with me from LinkedIn, which I love that feature. I also have a YouTube channel, David R. Priest, once again, real simple. And on that, I've got training for passive investors. So if you want to, I've got a 5-hour course on there for free for passive investors. If you want to learn apartment buildings and being a passive investor. And I put other videos on there about our principal protection program, our fund. I've got videos on IRAs. I've got a video on another deal we're doing right now. That's on there. So check that out. And if you have any questions, get in touch.
Thank you so much. It's been a pleasure.